Hi everyone and welcome to the Everyman Investor. So in today's video, I'll be going through earnings report and earnings call. So now that we know how to find a wonderful company to buy at a fair price, the next thing we need to do is to be able to follow the progress of the company. And this can be done through going through the company's earnings report and sitting through the company's earnings call. So the earnings report is a quarterly filing that every company listed on the NYSE, the New York Stock Exchange, is required to present every quarterly. This is all open source data. It is available publicly. You just have to go to the company's investor relations page and everything should be there. It can also be obtained through certain headlines. You can just Google it. But the thing is, the headlines usually do not provide details, which I like. In terms of knowing the details of each earnings report. So the earnings seasons, typically the Q1 will be January to March, Q2 April to June, Q3 July to September. So you can see we are sort of nearing the end of Q3 earnings season already, and Q4 will be October to December, where we start getting busy again. So the typical format will be a press release of the data before the earnings call. The earnings call itself usually lasts for about an hour or so and is divided into two sections. The first half hour usually is a presentation of the results by the company management, and the earnings call second part will last for about half an hour as well. It will be a Q&A with the analysts from different organizations. So how do you grade an earnings report? So there is beating the targets, missing the targets, and meeting the targets. And the share price movement usually corresponds to that. So if you beat the target, the share price goes up. If you miss the target, the share price goes down, and if you met the target, the share price might be just flat. So the earnings report itself, the headline numbers will be the things that most people look out for. So there will be revenue, there will be earnings, which is GAAP versus non-GAAP. So GAAP is basically an earnings format that is based on regulated accounting principles, whereas non-GAAP reporting can be very variable depending on what is added into or taken out from the report by whichever accountant is actually doing the earnings report for the company. So for a standardized earnings report consistently throughout all the companies, I usually use the GAAP earnings because of, like I said, it's standardized per accounting principles. So then the earnings will be reported as the pure earnings and the earnings per share. Again, I use the GAAP EPS and the operating income, and they will usually give guidance for the above headline numbers for the next quarter. So under the surface of the headline numbers, some companies will actually break down the revenues and earnings by their business segments. So for example, say Microsoft, there is cloud, there is gaming, and there is office. So these segments will be broken down and they'll give you sort of year-over-year growth or decline in the revenue and earnings from these different business segments. Then there are margins, which is basically how much the company makes from its revenue and translates into earnings. So there's gross margins, which I usually ignore. I go to the operating margins, which is a more better representation of how much money the company is actually making from its operations. Then there will be bookings, orders, backlog, and billings. So how this differs is very simple. Bookings and orders backlog basically are almost the same. So for example, say I book a company's service. So I have made a contract with the company, but because the company has got other obligations to other companies before me, I'm in the queue. So I have made that contract, but the company has not given me the service yet, so they cannot earn money in terms of revenue from me yet. It is pretty much the same as the orders backlog, which is basically I'm part of the orders backlog now. And then there's billing. So what happens is when the company is ready to start providing me the service that I booked for, they will bill me. But the thing is, billings might not be all at one go. So they bill me, for example, a year's service, but the service is provided monthly. I'm not going to pay them for the whole year's service for a 1 month service provision. So I will pay them every month. So the billings might not translate into immediate revenue. Then there's cash flow and free cash flow. Cash flow basically is just the amount of money that they have available. Free cash flow is the amount of money they have available minus any expenditure they might have. And there's CapEx and OpEx, which is capital expenditure and operations expenditure. So capital expenditure usually is one-off items. For example, a company that is involved in car manufacturing, they are going to build a new plant to manufacture cars. That will be under capital expenditure versus operational expenditure, which is basically how much money they pay their employees every month. So that's a recurring cost. So let's take a look at a company that we should be familiar with now, which is Fortinet. So this is Fortinet's recent quarter's earnings that was reported on August 3rd. Now we can see that they break down the revenue into product versus service revenue. So product revenue will be the stuff they sell. For example, they sell firewall, that'll be the product, versus the service whereby they have to go in and maintain their firewall and things like that. What I'm more interested in is the total revenue and the growth, more importantly, which is up 26% year over year versus the second quarter of last year. Then there's the billings, which was up 18% year over year. There was deferred revenue. So remember when they bill us, we don't have to pay everything at one go. We pay as they provide the service. That will be part of the deferred revenue. And then there is the GAAP operating income, which is what I'm very interested in, which is the amount they earn through the operations, which is up 43% year over year. The GAAP operating margins is 21.6%, which is pretty good. And the diluted net EPS, the GAAP one, will be 0.33, which is up 57% year over year. The cash flow is great. It's $500,000. Free cash flow is 438.3 million. So basically, this looks like a very, very good report for Fortinet for the last quarter. Everything is growing nicely, and it should be considered as a very, very nice report. Now let's take a look at guidance that it provides. So it provides guidance for the next quarter, which is Q3. So we can see that the billings guidance will grow 12.7% year over year, which seems a bit lower than its previous quarter. The revenue will grow by 17%, and the margins basically are, the operating margin is 24.5 to 25.5%. EPS will be 0.35% to 0.37%. So now we look at the 2023 full year guidance versus 2022. You can see that billings expected to grow 16.9%. Revenue is growing very nicely at 22.3%. The operating margins pretty much the same as the guidance for the quarter. It's actually down a bit from 2022, but 25.25 to 26.25% operating margins is pretty good, so I'm not too worried about that. As you can see, the EPS guidance is very, very good. So the 2022 actual EPS was 1.19. The 2023 EPS is 1.49 to 1.53, which is excellent. Again, guidance is good, the earnings report is good. So this is what happened after Fortinet reported its earnings. So before the earnings report, the share price was trading at $75.76. After the earnings report, the stock price ended at 56.77. In short, there was a great sell-off. The stock price dropped 25% after what looked like a very good earnings and guidance. So why did that happen? So let's look at the previous quarter. So the previous quarter, they actually provided the Q2. So this was Q1, the earnings, and they provided Q2 guidance, which is what we just went through. So let's see what happened there. So this is the Q2 reports, and from the guidance of Q1 to Q2, we can see that in Q1, they said that Q2 revenue will be 1.28 billion to 1.32 billion, and the actual revenue was 1.29 billion, which is within their guidance range. Now, the billings fell short. So the billings was supposed to be 1.56 to 1.6 billion, but the actual billings for Q2 came to 1.54 billion, so that's a bit down. And the EPS was 0.33 actual and guided for 0.33 to 0.35, which is within the range of guidance. So the only thing that missed was 2.5% miss in the billings, which led to a 25% drop in the share price, which seems to be rather irrational. So this is usually what happens typically when a company misses earnings. In any aspect of the earnings, can be revenue, can be guidance, can be EPS, can be margins even. The market goes crazy, goes wild, and people start selling off the stock in droves. And it's sort of like a herd mentality. Once someone sells, everybody else sells. So let's look to the great man for advice. Now, Buffett says to be fearful when others are greedy and greedy when others are fearful. And let us see how this applies to this situation. Okay, should a company be punished by a 25% decrease in its share price when the only thing that it missed was a 2.5% miss in its billings, but otherwise it's growing very well into from about 15 to about 25% on all other metrics of its earnings. And say we think logically and say that that's ridiculous. It should not have dropped that much. So let's look at the company financials in detail and think about it logically, and say we decide that, okay, this is a super overreaction to the earnings, and it's probably doesn't make sense, let's buy the company stock since it's dropped so much and it's trading at a discount. So if you had done the rational thing and be greedy when others are fearful, and you bought the stock at its bottom at the close of the day, you will be sitting on a 12.8% gain now, since the stock price now is $64.07. So in general, there will be a extreme reaction once the earnings are released, followed by a more rational reaction as the days and weeks go by subsequently. So this is when we can opportunistically buy stocks at great discounts, at great value, if we already know the company, if we have researched the company, and if we actually look at the earnings report in a very logical, clear-headed manner, without panicking as per what the market did actually. So the question is, how does this benefit us, and did I actually do something during that period of time? No, I did not buy Fortinet shares when it dropped, but what I did was I bought it in Q4 last year. I actually had a position already, which was about $55 per share. So the last earnings in Q3 last year it started the day at $56.42 and it ended the day at $45.93. I bought it at $46. Again, there was a slight revenue miss, which was really very minimal. I think it was something like 1%, and the share price collapsed. And to me, that was a fantastic buy opportunity. And so in the end, by dollar cost averaging, my buy price is now somewhere in the region of $50.50 or thereabouts. So you can see that I'm making a very nice profit on Fortinet stock just by being logical and by analyzing the earnings in a rational manner instead of panicking and just hitting the sell button. Okay, so what I bought actually when Fortinet reported and the earnings or the billings came out slightly short was Palo Alto. Okay, what happens is that when a company in an industry who is a market leader, as Fortinet is, reports something that the market doesn't like, other companies in that industry will usually suffer as well. So on the day that Fortinet reported its earnings, Palo Alto earnings actually dropped. So I picked up Palo Alto shares at $225 on the day itself when I saw the stock price going down. As you can see, the 52-week high is 258.88, and it basically came down by more than 10% from its highs. And given that we already went through the price to sales ratio, it is a good value at that price. Now, if you look at the P ratio, it's 193.64 at $248. It was probably lower at 225. But the thing is, like I explained in the previous presentation, Palo Alto just turned profitable, and so the P ratio is very skewed. So the PS ratio will be a much better value in terms of assigning a fair value to the company stock. Now, from this chart, you can see that I have no idea how to time the bottom of the stock or the markets. Okay, so the October 2022 buys were based on discount to fair value and not because I had some sixth sense that can tell me when the bottom is going to be. So what happened after Palo Alto posted earnings was that they beat everything. And the earnings, after the earnings, on the earnings day itself, or after the earnings day, the stock price shot up. So I am now in the green on Palo Alto, thanks to Fortinet's miss in billings. So as I mentioned previously, I have an equal weightage value. So like I have, for example, say I have got 10 stocks at $1,000 in terms of value for each of the positions. So what I did was I bought a full position size in Palo Alto. And since I already had a full position size in Fortinet, I decided not to add on to it. Rather, I bought its competitor, which supplies a different portion of the market. Okay, so the earnings call, which happens usually on the day of the earnings report, is something that I look forward to nowadays. Previously, I didn't bother to attend or listen into the earnings call because I felt that having just data from the report would be good. But then after the first earnings call itself, I realized that there was a lot of information you could gain from it. So what happens is that usually the CEO, the CFO, the CIO, which is Chief Investment Officer or Chief Technical Officer, depending on the company, will present the results from the earnings report. And they provide commentary around the business performance during the reporting quarter and add some context to the figures reported. So for example, they might say that, oh, this portion of the company is earning a lot and is growing its earnings a lot, versus say this portion of the company that's not doing so well, but we have got these plans to help with that area of the company. And then they will also provide updates to investors about the progress of any current expansion plans, or as well as any future expansion plans. So you listen to the call. Usually, if a CEO or CFO is very confident, they can outline the earnings, why it suffered, if it suffered, why it did well, if it did well, and can outline what's the progress of the company in meeting its goals for the future. That is a good sign usually. Now, I've attended earnings call by the company CEO and CFO sort of push the questions to each other. There's a lot of hesitancy and uncertainty. We do not know this, we do not know that, and that can be very disconcerting. And suffice to say, I didn't buy the company stock in the end. So I attend earnings call for not only companies that I own, but companies that I'm interested in and that I have already researched. Now, the second portion is the Q&A, which is really great. So the analysts from the various institutions will ask questions because, as I mentioned previously, these are the guys who come up with your target price. They will rate the stock whether it's a buy or sell or hold. And they need to ask these questions to update their analyst ratings and target price after the quarter's earnings. So usually there is no place to hide from hard questions because the CEO and CFO are basically sitting there on the call listening into these questions. If they say that I have no idea whatsoever, they know that people will know that something is wrong with the company. So the earnings call, the reason I call a call is because it's purely audio. There's no video whatsoever. And you can attend it just by going to the investor relations site for every company. You can register as an individual investor. So you just have to put your name, your email address, click on the option that says individual investor instead of there is institutionalized investor and analyst or something like that. So that's all the information they need from you, and you can either listen in live or you can listen into a recording that was made. So I find this to be one of the best things ever since I found out that you can actually sit in as an individual investor. So since we have time, I will go on to when to sell a stock. So as I mentioned, we have an investment thesis on cybersecurity stocks, for example, in this case Fortinet. So when do we sell? We sell when the investment thesis is no longer relevant. For example, the cybersecurity industry starts to contract. So instead of growing, it starts to get smaller and smaller. So means to say the pie is smaller and smaller, means to say that the companies operating in the industry will be having reducing earnings and revenue. Or for example, say a new company comes along with a better product and it takes over as a market leader. I would cut off my position in Fortinet, for example, if that happens, and probably buy into the new company. But that is not happening now. I would like to emphasize. I have seen the earnings for both Fortinet and Palo Alto, and both are doing really well, which is why I kept my position in one and started a position in the other. The other time to sell a stock, obviously, for us as retail investors who actually work within budgets, is that when we need cash for certain purchases, house, car, among other things, wedding expenses. And then there is this thing called the stop loss, which I highlighted in a previous presentation on stock picking services. So the thing is, the idea behind a stop loss is that, for example, if a company, say, is trading at $10 per share and it loses 50% of its value, it goes down to $5, for the company to make back what you actually put in, you have to go up by 100% from that $5. So usually the recommendation will be a stop loss of say 20 to 30% so that you can sort of preserve at least some capital. Now, there is one investor who does not believe in a stop loss, and that is Warren Buffett. Buffett believes that if you buy a house for $100,000 and you know the house is worth $100,000, and someone comes along and says you should sell it for $90,000, it makes no sense. He uses that same principle to a stock that he has valued and that he believes the value is right. So let's take a look at why a stop loss is not such a good idea in certain situations. So this is NVIDIA's stock chart. Okay. So as you know, NVIDIA is a leader in AI chips, and it is the hottest property in the market at the moment. So I started my position at around $245 in 2022. And then the share price started dropping and dropping and dropping. The reason behind that was the US chips ban on chips shipments to China, especially AI chips. So what NVIDIA did was they actually dumbed down one of their AI chips, and they say that it met regulations for what could be shipped to China. But then the thing is, everybody was very uncertain about how the market would react to that and how badly NVIDIA sales would be affected. Now, if I had followed the stop loss at 30%, I would have sold it at $171.50. And I would have missed the bottom in terms of losing money, but at the same time, I would have missed it going up to $455.72 as at the time of this presentation. So, in short, by not following a stop loss and looking through my investment thesis, which is NVIDIA is the AI chip leader, it is still the AI chip leader even though its chips have been banned from being sent to China. The question is, how much of its revenue is going to be affected by the loss of the China market? Even if there is a significant loss, we know that semiconductors are likely to be in increasing demand as AI accelerates. Hence, over a long period of time, my investment thesis is that NVIDIA will still make money even if there is a short-term price drop. And that turned out to be true. So from $245 in my initial investment, I'm now sitting on $455, which is up about 85 to 90%. Now, the thing about NVIDIA is that I have not added to my position since. Firstly, because of uncertainty about how the China market was going to affect its revenue and earnings. And secondly, now, because look at its PE ratio. Its PE ratio is 110, which is in the stratospheric range. So the thing is, if you look at the current share price and the share price action, you can see that NVIDIA's stock has sort of plateaued, mainly because people are starting to see that people are paying an extreme premium for a company, and that it is now priced not only to perfection, it is priced beyond perfection, meaning to say that if it doesn't beat on its next earnings, the share price is going to drop. Now, if the share price drops to a nice value that I think it's reasonable, I will probably add to my position at NVIDIA, but not at this price. So as you can see, as I mentioned, I'm not taking that stop loss. I have rolled the markets up and am now sitting on a nice little profit from NVIDIA stock. So thank you for watching this video. I hope it was useful in helping you understand how to actually interpret an earnings report, and also how to buy the stock at a nice discount if you can rationally look through what is sort of the market rating as a missed earnings report. So I hope this information will be useful to you as you buy your own wonderful stocks, hopefully at nice discounts. So thank you very much for watching, and I hope to see you at my next video.